All right, we're back with the Surrey Report for April 2019. It is tax time, and we're sitting here with Jimmy Le-Tang.
Le-Tang.
Jimmy Le-Tang, out in Vancouver. Full disclosure, my personal accountant. So if the CRA is looking and I got any trouble,
I'm the guy. I'm the guy.
But first, let's get to the team and the market update for the Surrey combined area, April 2019.
Starting off with the condo market in Surrey, we're looking at month-over-month gain of about just below 2%. Our benchmark price is hovering right around $439,000. If you look at the year-to-year numbers though, we're still down by about 4%. And what that means is if you look at the price today and the price a year ago today, we're still 4% lower than what it was last year. Now with the gains we're having over the last couple months, we're slowly but surely tracking back to those numbers of last year.
And in our townhouse market, benchmark price is hovering around $563,000. Now that's a 0.4% increase month over month, but year over year, it's still a decrease of 4.8%. Now in a down market, there are a lot of buying opportunities out there. And one that I found was Cloverdale townhouses. The benchmark price year over year is down 10%. So if you weren't able to get into the market last year, well, now is your time.
The detached benchmark price for Surrey combined is hovering around $1,065,000. This is down by 0.1% month over month and down 4.3% year over year. What does this mean to you? Opportunity. There's less competition, prices are down, the gap between attached and detached housing has closed, and to top it off, interest rates have moderated by a 1/4 point.
All right, so Jimmy and I went for lunch last week before, and we were sat down, talk about a bunch of tax things, and we started in on conversation regarding income properties.
Right.
And I had some questions, and Jimmy taught me some things I had no idea about, and it may be very important to you out there with investment properties.
Absolutely.
So the first thing I asked you about, or I was talking to you about, was when people maybe move out of a property and then start renting out that property. So you didn't have to sell. Everybody tries to, with their condos, keep their condo and then move into the house and then rent out the condo.
Right.
Then a few years down the road, they go to sell. They come back to me and say, Steve, I need to know what that condo was worth when I moved out because I didn't sell it. Now I have to report to the CRA. And you actually mentioned something to me because I just view capital gains in this case because it's now non-primary residence from the time they moved out to the time they sell. I basically use the dummy math on that, which is 50% of the raise gets taxed at 50%.
At whatever the marginal tax rate is for the year of the sale.
Okay, so then you told me how they can actually save tax on that, and that's why I wanted to bring you in.
Absolutely. So there's a planning opportunity when there is a change in use of the property from a principal residence to a rental income property. There's a deemed disposition, of course, and that's what everybody knows about. And you're actually supposed to report that deemed disposition, the change, in the year that it happens. And I
think that's maybe where people were. I mean, myself, I didn't pick it up. I'm not a tax guy. I'm the real estate guy. That's what I wanted to focus on was you told me if you actually file, what's the report called?
There's an election that you can file in the year that you change the property's use.
Okay.
That will open up some opportunities to you for additional tax planning where that change in use is waived for that year and you don't have to report the sale. And then when you actually do sell the property many years later on, you have the ability to calculate your capital gains maybe in a slightly different manner.
So if you file that election, it has to be done the year you move out of the property?
Correct.
Okay, so that's the big key.
Yeah.
If you want to save on the tax, but then you did the calculation for me. I'm not going to bore you here. You can call Jimmy and find out what the calculation is. But if you file that within the year of the change of use, meaning the year you started renting it out and moved to your second property, you will actually save taxes.
Probably.
And
where I'm getting with that is that you have the opportunity to choose how you're going to calculate those taxes.
Okay, so right. You like to use the word, is it opportunity?
It's an option. It's an election.
It's an election to possibly file your taxes differently, which I didn't realize in the example that Jimmy did for me actually would have saved that particular client we were discussing money. Now, not to the tune of a massive fraction, but it was, let's call it about an eighth.
Yeah, still thousands.
Yeah,
right?
so thousands of dollars, specifically over the last 3 or 4 years where we've seen those properties rise in value. Your property could have risen $200,000, $300,000, $400,000 over the last few years. You could be saving a bunch of money.
Absolutely.
Now, the second question I had for you was the reverse.
Right.
So someone who has bought a condo and they intend to retire into it. So the first, let's say, 10 years they own the property is now capital gain, correct? So my thought was, okay, well, do I have to pay that capital gain when I move in? And that was my question to you. So what do I do with that capital gain? So let's say I bought a place and it was $400,000, now it's $600,000. I sold my primary residence and now I want to move in. Do I pay taxes that day?
Sorry, the example again was the principal residence we're talking about?
I sold the principal residence and now I'm moving into my investment
Oh,
condo.
okay, you're moving into the investment condo. Yeah, so in the year that the change in use, so this is the reverse of the change in use from from an investment property to a principal residence, you have the opportunity to file an election. Now, if you didn't file the election, then yes, you're supposed to have a deemed disposition, report the capital gain, and pay the taxes on the capital gain for the year in which you moved back into your rental property.
But you told me then we can defer that tax?
You can. So you can defer the taxes on the capital gain by filing, yet again, another election that tells the CRA you're going to defer those taxes. Now, the difference with this election, though, is this election isn't due until the year in which you sell the property, right?
Okay.
So if you
you're
forgot,
you're deferring the taxes. So where this might be of concern to some people might be if you're getting an inheritance and that person possibly had rented out the property previously, you may not be getting that whole inheritance as you would in some sort of a situation where it was their principal residence.
Yeah, but if we're talking about inheritance, there's actually a whole bunch of other issues
It's a whole
involved.
different thing.
Yeah,
Okay,
it's
well,
a whole other thing.
We won't get into there. We're going to keep it simple for dummies like me. Jimmy, again, if you got specific tax questions, give him a ring. But the other question I had for you, and this is very close to what I deal with on a regular basis. And one specific instance is my neighbor. Every time I see him, we got to talk real estate. That's the nature of my business. And he's constantly, he or she, I don't want to give him away, is constantly asking me about flipping a pre-sale, buying a condo, that sort of thing, and how, you know, my neighbor, my brother, my cousin, whoever bought a property and they made $150,000 on it. So what I did was I posed that question to Jimmy and I wanted to find out what the real profit was.
Absolutely.
So here's the example I gave to Jimmy, and it is reflective, if I'm not mistaken, on the actual income you're already making.
Yep.
Okay, so if you make no money and you don't have an income,
the numbers are different.
You can save a little bit more.
Yeah.
But let's go through the numbers that we went through here. $400,000 purchase. So let's say I bought a condo a few years back. It was $400,000, and now I'm completing on it this year.
Yeah.
It's worth $550,000.
Yeah.
Okay, so my neighbor tells me, okay, my buddy made $150,000. I said, Jimmy, what did he actually make?
Right. So underlying this assumption here is that the property is purchased and then sold right away.
My question was, so now an assignment of contract is a great thing if you can do it, and you could possibly make some money. However, I'm going to assume, given our current market, that most people will need to complete on those properties and then try and resell.
Right, right. And in that course of during that period of time, they did not occupy the purchased property as a place of residence. They didn't rent it to somebody else either. So it's basically sat empty for the little while that it took for them to sell it.
Trying to flip it to make a profit of $150,000.
Right. In fact, so the neighbor did not make $150,000 because the neighbor did not take into account the income taxes that are calculated on the profit margin. The neighbor also didn't take into consideration the GST issues as well too, right? Because you're doing this now in the course of a business, it wouldn't be GST exempt, right?
Now, this is one of the things that you brought up, and again, this is why we have accountants, and I don't do my taxes myself. You did say that in the event you were going to do this transaction, you would benefit from getting a GST number as a business in advance of the purchase.
Right, in advance of the purchase, so that on the completion date of the initial purchase, you've already got a GST number in place.
So you can then be reimbursed. Now, is it a cash flow thing? Can you not get reimbursed for
Yeah,
that GST?
so if you didn't have a GST number on the first completion, you can always get a rebate afterwards. But a rebate is a separate application to the Canada Revenue Agency, so there is a timing difference in the cash flow.
Okay, and the thing this is the biggest misconception with resale of pre-sale, say that 5 times fast, is GST is not payable when I resell it, because now I've paid GST once and the new buyer does not have to pay GST. We see this in ads all the time. Is that true?
No, that's not exactly true, because what really matters is on the first use of the property after completion, the first completion, was the property occupied as a place of primary residence for either the owner, or did the owner lease that property out to somebody else who would have occupied it as a place of residence, or did the owner lease that property out in like a short-term rental type of thing?
Okay,
right?
so let's assume in the scenario I gave you, $400,000 I'm selling for $550,000. That $550,000 is GST again in. All right. Now, what Jimmy asked me is, it really depends on what that person made as part of their other income in the year for their tax rate. So don't forget, there's also realtor fees. We've also got legal fees. If you got locked into a mortgage, there may also be mortgage dispersal costs, all sorts of fees. However, when we look at just standard realtor fees, even though we're not allowed to call them standard, I better get my disclaimers in there too. That $150,000, let's say I made $80,000 last year. Break it down for me in simple terms.
Yeah.
How much profit did I make out of my $150,000?
Okay, so we know you got your profit margin of 150. You're going to have your realtor fees. I'll leave Steve to calculate that for you.
Let's call them 20 grand as a flat fee.
Sure. So you got $130,000. You also got your property transfer tax that you would have paid on the initial purchase. You've got your legal fees. You might have accountant's fees. Really, we're talking about a net profit margin that I guess would push us into about $100,000, maybe $110,000, right? Okay. And then you add that income to your $80,000 of employment income, and then your taxes, your marginal tax rate is probably going to be in the neighborhood of 38% or so. Okay. So your profit margin on just that property flip, you're paying a tax rate of roughly 38%.
38%. Okay, so you did the calculation. I'm not going to bore you with all of the numbers, but you did the calculation given the terms we just discussed.
Yeah.
Jimmy, how much money did my neighbor's buddy make?
Yeah, so from that $150,000 profit margin, minus all your expenses, your net profit is really in the neighborhood of about $57,000.
$57,000 profit. Now there is some money maybe coming back from GST.
Yeah,
depending on
absolutely. So there's some GST. So really, you're looking at a range of maybe upwards of about 75.
Okay.
Right.
So when the tax man comes knocking, now maybe my neighbor's buddy didn't pay all his taxes, but that's not what we're here to do.
That's right.
We're here for Jimmy to show you the benefits of how you can save on taxes, not avoid them completely. That would be a heck of a problem. But I think maybe the reason is a lot of people maybe are avoiding these taxes, or they're just not bragging with their friends about how much taxes they paid. It's way better to say I made $150,000 than $57,000. Right? So this is something that's really, really important for any of you out there that are considering pre-sales. There is income tax involved.
Absolutely.
There is capital gains involved on any revenue properties.
Yes.
Yes. So principal residence is still exempt at this point in Canada.
Yeah, but you got to make a claim for it.
But now you have to claim that changed last tax season.
That was effective in the 2016 tax year.
Okay, so these are all things that I don't claim to be an expert about because I'm just the real estate agent. He's the tax guy. So Jimmy, is there anywhere they can reach you? Do you have a phone number, website?
Yeah, absolutely. You can reach me by email, by my website. That's will be jltcpa.ca. My phone number is also on there as well too. So if you have any questions, reach out to me. Just say that you're Steve's client. I'd be happy to answer your question for you.
Awesome. Thanks so much. I appreciate it. Jimmy, it was great to come in. It is tax season. Get your taxes filed. And if you got any questions about your investment property tax, call Jimmy.
Thank you.
Thanks, Jimmy.
Take care. Have a great day.